Okay, so well, thanks a lot, and thanks for being here. I'm very happy to have the opportunity to present what was my job market paper, International Reserves and Central Bank Independence. I am a PhD candidate at the University of Minnesota, and I also work as a research analyst for Javier Bianchi at the Federal Reserve Bank of Minneapolis. And as Joaquin said, starting in August, I will join the research department at the World Bank. So the usual disclaimer: this paper represents my view and not the views of any of these institutions. So this paper is motivated by a well-known fact, which is that emerging market economies hold large amounts of international reserves and public debt. This is a puzzling behavior because economies facing default risk pay high interest rates on their debt and receive low interest rates on their reserves. So this paper deals with the question of why economies paying significant sovereign spreads prefer to accumulate international reserves instead of using these resources to pay back public debt. I propose a novel theory of reserve accumulation that emphasizes the role of an independent central bank in an environment where the government lacks fiscal discipline. I find that independent central banks accumulate international reserves to undo excessive government borrowing. So let me tell you exactly what I do in this paper. So first, I use the Euro Central Bank independence data for 11 Latin American countries to document a positive correlation between reserve accumulation and central bank independence. Then, motivated by this novel fact, I enhance a sovereign default model with an independent central bank that can accumulate a risk-free foreign asset. As is usual in sovereign default models, I assume that the government can issue defaultable public debt. I show that if the central bank is more patient than the government, in equilibrium, there will be a conflict of interest among policymakers that let me rationalize simultaneously positive levels of international reserves and public debt. This is a relevant result because in an early important work, Laura Alfaro and Fabio Cansuk shows that canonical sovereign default models, as Arellano 2008, cannot rationalize simultaneously positive levels of reserves and debt. A nice feature of my model is that I can shut down the central bank independent channel just by assuming that the central bank is as impatient as the government. And when I do this, I can replicate the results by Alfaro and Cansuk 2009. So I exploit this feature of the model to quantify the welfare gains of having an independent central bank that can accumulate reserves. The main quantitative result is that my central bank independent channel can account for 83% of the average level of international reserves observed in Mexico from 1994 to 2017. In a quantitative exercise, I show that by accumulating reserves by 7.2% of GDP, the central bank is able to improve the foreign net position of the economy by 3.3% of GDP, and this increased social welfare by 0.1%. Welfare gains come from reducing the cost of front-loading public spending and mitigating the distortion in households' intertemporal consumption. A key insight is that the central bank's ability to offset government borrowing depends on the fact that the economy is facing significant sovereign spreads. For any level of reserves, the government can issue more debt to undo the effect of reserve accumulation on the net debt position, but chooses not to because this will increase spreads, making it more costly to borrow and reducing the amount of consumption that can be front-loaded. Overall, I believe the main contribution of this paper is to provide a novel motive for reserve accumulation. So let me use the next slide to summarize what are the main motives for reserve accumulation in the literature. So one strand of the literature studies the role of international reserves in the foreign exchange market. And a second strand of the literature highlights the precautionary motive for reserve accumulation, which means that central banks accumulate reserves to provide liquidity in bad times. Other studies seeking to explain the demand for reserves include these papers. So overall, in this paper, I abstract from the exchange rate motive, and I focus on the studies that explores the joint accumulation of international reserves and public debt in sovereign default models with one tradable good, as in Alfaro and Kansuk 2009, and Bianchi, Hachondo, and Martinez 2018. I depart from these two papers by relaxing the assumption of the consolidated government, which means that the government behaves as a consolidated entity, choosing simultaneously reserves and debt. So instead of that, I assume two different policymakers that differ in their discount factor. So the assumption of a consolidated government implies coordination between policymakers. Therefore, by relaxing this assumption, I provide a tractable model in an environment where there is lack of coordination between the central bank and the government. So now let me motivate not only this lack of coordination between policymakers, but other three key ingredients for my model. So the case of Argentina in 2010 illustrates this lack of coordination between the government and the central bank. So what happened is that President Cristina Fernandez de Kirchner announced a plan to use international reserves to pay back public debt. But the central bank president, Martin Redrado, refused to support her plan. And after that, Mr. Redrado got fired by the President Fernandez de Kirchner by a presidential decree. Then a federal judge blocked her plan and ordered Mr. Redrado reinstated, saying that according to the central bank law, only the Congress can remove the central bank president. So this conflict between the government and the central bank president illustrates not only the lack of coordination between central bank and government, but also illustrates that the central bank might be more prudent than the government about the use of reserves to finance a public deficit. And also illustrate that central bank independence allows central banks to manage their reserves without interference from the government. On top of this, I also document positive correlation between international reserves and central bank independence that suggests that more independent central banks tend to accumulate more reserves. To do so, I use the Euro Central Bank Independence Index for Latin American countries. What I'm showing you here is the average for these 11 Latin American countries. And what is interesting about this region is that in the early 90s, there was a widespread adoption of central bank independence legislation that you can observe in this jump. And what is even more interesting is that this secular increase in central bank independence was followed by an increase in the level of international reserves as percentage of GDP. Since I am aware that the positive association between reserves and central bank independence might be driven by other confounding factors, I also do a panel, a fixed effect regression, where I regress the level of reserves as percentage of GDP against the central bank independence index, the cyclical component of GDP, the debt to GDP, and I control by country fixed effects and time fixed effects. So overall, the results of the regression analysis shows that the positive correlation between central bank independence and reserve accumulation is positive and robust to different specifications. So finally, last and but not least, as a motivation, let me mention that the case of Argentina in 2015, it is also a very good example, or illustrates pretty well, that according to international law, the international lenders cannot seize the reserves held by the central bank, even in the case that the government defaults on international liabilities. So basically what happened is that in 2015, the Argentinian central bank won the reversal of a US court ruling that had allowed bondholders to move forward with a lawsuit targeting the central bank reserves for the debt defaulted by the Argentinian government in 2002. So this case sets an international precedent and guarantees that lenders cannot seize the reserves held by the central bank in default. This is going to be an assumption in my model, and it's going to be crucial for the mechanism of the model. Because without this, the relevant statistic will be the netted position as in a standard model, as in Arellano 2008. So let me summarize three key ingredients of this theory. One, central banks might be more prudent than the government about the use of reserves. Two, central bank independence allows central banks to manage reserves without interference from the government. And three, international law protects central banks' reserves in case of default. So basically, I will show you that these three ingredients together can rationalize a rise in international reserves in a sovereign default model. So let's go to the model. So this is going to be a canonical sovereign default model, as in Arellano 2008, and I'm going to add an independent central bank that can accumulate international reserves. There are going to be three main assumptions. One is that both policymakers, government and central bank, maximize the utility of the households, but they differ in their discount factor. In particular, I'm going to assume that the central bank is more patient than the government. So I follow the sovereign default literature by modeling political pressures as given the government a low discount factor. However, I assume that an independent central bank can be isolated from these political pressures. And this is why I assume that the central bank is not as impatient as the government. And I will assume an impatient government and a central bank that is patient and as patient as household. So, and another assumption will be that, as I mentioned, lenders cannot seize the reserves held by the central bank in case of default. So now let me describe the rest of the environment very quickly. So this is a small open economy with a stochastic endowment populated by households, central bank, and government. Households receive an stochastic endowment, and they pay an inflation tax. that is going to be exogenous and constant over time. And I'm going to assume that is large enough to finance the accumulation of reserves. And they also receive transfers from the government, and basically they use the endowment after taxes and the transfers to consume. The central bank receive the inflation tax revenue, and they can use these resources together with previous assets or previous reserves, either to buy international bonds at price Q star, which is gonna be the international price, and it's gonna be exogenous and constant. And so they can buy reserves, or they can also transfer these resources to the government, which is denoted by omega. The government receive transfers from the central bank, and they can also issue debt in the international markets at price QT, which is different from Q star. And this price of the domestic bonds will reflect the probability of default, which is going to be endogenous in the model. So they can issue new debt, and they use these resources either to make transfers to the households or to pay previous liabilities. So, as I mentioned, policymakers maximize the utility of the households, which depend on the stream of consumption, but they differ in their discount factor. Beta F denote the discount factor of the fiscal authority or the government. Beta M denotes the discount factor of the monetary authority of central bank. And in particular, I assume a benevolent central bank in the sense that is as patient as households and an impatient government. So if I put together these three budget constraints, I get the resource constraint as usual. And what is interesting here is that basically this assumption will introduce a disagreement about the path of consumption or the net debt position of the economy. And basically policymakers have different instruments to affect the net debt position of the economy or the consumption. So basically the impatient agent is the one choosing debt, and the patient agent is the one choosing reserves. So let me talk a little bit about what happened in default. So there, I'm going to assume identical foreign lenders with a stochastic discount factor. Government choose either to default or to repay. If the government defaults, then I assume exclusion from financial markets with reentry probability theta, exogenous default cost, zero recovery rate. This is pretty usual in the literature. And so in case of default, this is the resource constraint of the economy. So basically, the government do not have to pay the previous liabilities, but also they cannot issue more debt. There is a penalty for default, and the central bank retains their reserves, and they still have access to the financial markets. So let me just describe the timing, and then I'm going to illustrate the mechanism in a simplest version of the model. So basically, shocks are realized, and the aggregate state of the economy will be given by the endowment shocks and the risk premium shocks, the initial level of debt, and the initial level of reserves. Then the government choose either to default or to repay. In case of default, the government is excluded from financial markets, and the central bank is the only one choosing the net debt position of the economy by choosing the level of reserves. And in case of repayment, then I'm going to assume that policymakers move simultaneously. So the government choose the new level of reserves, taking as given the price schedule of the bonds, and the central bank choose the new level of reserves. So, and finally, households consume. So since households only consume their endowment, and lenders provide the amount of debt demanded by the government as long as the price of the bonds compensate the risk, then the only two strategic agents of the model are the policymakers. So basically, this is a simultaneous game between the government and the central bank. The government choose the default choice and the new level of debt, and the central bank choose the new level of reserves. So the solution concept that I'm looking at is the Markov perfect equilibrium, which means that the strategies depend only on payoff relevant state variables. So now let me show you the mechanism of the model in the simplest version of this economy, which is the deterministic case. So let me assume that there are no endowment shocks. So the endowment is equal to 1 and constant over time, and no risk premium shocks, zero re-entry probability, and I'm going to assume exogenous and constant default cost. So basically, in this environment, I'm going to show you two different economies. One that I call the consolidated government economy, in which the central bank is as impatient as the government. And this is similar to Alfaro and Kansuk 2009. And then I'm going to introduce what happened when I introduce my independent central bank, in the sense that the central bank is more patient than the government. So as you know, like in this deterministic environment, there is no default in equilibrium. And instead of that, what we have is a endogenous borrowing limit. So basically here I just have the characterization of this borrowing limit under some assumptions. Basically, when I assume that the central bank is as patient as the rest of the world, it is very easy to get a characterization for the borrowing limit that does not depend on the level of reserves. So basically, this is going to be very helpful to illustrate the mechanism. So basically, this is the borrowing limit, as I mentioned, is constant and doesn't depend on reserves, just in this specific case. And what I show you here is what will be the choices of a consolidated government, starting in given initial levels of debt and reserves. Basically, an impatient government would like to consume their reserves, and basically they're gonna accumulate debt as long as they can until they hit the borrowing limit. And in this case, this will be the net debt position of the economy. And then the question is, what will be what happens if in this environment we introduce an independent central bank? So in that case, what happens is that the central bank accumulates reserves as long as the government issues debt. So basically, once that the government hits the borrowing limit, the one choosing the net debt position of the economy is the central bank. So in this case, for example, it is clear that the central bank can discipline the net debt position of the economy by accumulating reserves. And in this case, this will be the net debt position of the economy. So if we compare the net debt position from the consolidated government economy and the independent central bank economy, we can see that by accumulating reserves, the central bank can reduce the net debt position of the economy. And in this specific case, if we compare this with what will be the choices in economy populated by a benevolent social planner, it seems that it's exactly the same net debt position as in the case of an independent central bank. So in this example, by accumulating reserves, the central bank can implement the optimal net debt position.
So the discount factor of the central bank is the same as the discount factor of the household?
Exactly, yes. And so in this case, the central bank can implement the optimal net debt position by accumulating reserves. This is not the case in the stochastic version of the model, because accumulating reserves has a cost due to the spreads on interest rate between domestic bond and international bonds. But I will show you that accumulating reserves is still welfare improving. I don't know how much minutes do I still have, because I think we start a little bit late. 5, perfect, great. So let me now jump to the stochastic version, but I hope this helps to illustrate the mechanism. So basically, I just gonna mention, I calibrate this for Mexico using data from 1994 to 2017. I choose Mexico because it's a common economy to study reserve accumulation, and during this period, Mexico has a fairly independent central bank. So as you saw, the two main drivers for the reserve accumulation in this model is the difference in discount factors. So let me tell you exactly how I calibrate these parameters. For the central bank discount factor, I calibrate this externally by using data for the domestic money market interest rate. This is a real interest rate. And basically I choose beta M to match that interest rate. And for the government discount factor, I calibrate this internally by matching the debt to GDP observed in Mexico, which is around 44.4. So implicitly, that gives me, to do so, I need a discount factor for the government of 0.946. So basically, these are the main quantitative results. The first panel shows target moments, reserves to GDP, the mean for spreads, the deviation for spreads in bad times, and the correlation between debt and GDP. And the main result is that my model can rationalize 7.2% of GDP as reserves, while in the data we have 8.7. So basically this represents around 83% of the observed level of reserves. And also my model does a very good job matching the positive correlation between reserves and debt observed in the data, as long as and also the procyclicality of reserves. So these results are even more interesting when we compare this with the model with a consolidated government, which basically cannot rationalize positive levels of reserves, as Alfaro and Kansuk 2009 show. So let me just talk a little bit about the mechanism. As you saw in the deterministic version, like the ability of the central bank to discipline the netted position of the economy by accumulating reserves depends on the fact that the economy has an endogenous borrowing limit and the government is constrained by this limit. In the case of the stochastic version, this is not true, but instead of that, the government is implicitly constrained by the sovereign risk, or by the price of the bonds, which reflect the probability of default and the sovereign risk. So basically, it is important that the economy is facing significant sovereign spreads. Otherwise, for any level of debt, it is possible to undo the effect of reserve accumulation on the netted position just by issuing more debt. So to illustrate this, let me show you the bond price schedule as a function of reserves and as a function of debt. So the dot line represent the bond price schedule as a function of debt, and the solid line represent the bond price schedule as a function of reserves. So basically, as a function of debt is decreasing, as we expect from the standard Arellanos model. But what is interesting is that as a function of reserves, which is the solid line, it is pretty flat. And the reason of this is that while debt only affect the probability, the repayment value, because in default you don't have to pay anymore your previous debt. In the reserves affect both the value of repayment and the value of default for the government. So you can see this in these two graphs. So basically, the top panel is the value function, the repayment value and default value for the government as a function of debt, which is a standard. And the bottom shows the value function, the default value and repayment value as a function of reserves. So in this case, both are increasing on reserves. So this is why it is very important to assume that in default, lenders cannot seize the reserves held by the central bank, because otherwise this graph will look exactly as this other graph. And in this case, the relevant statistic will be the netted position of the economy. And the central bank wouldn't have the ability to transfer resources to the future by accumulating reserves. So I only have less than 1 minute, so I'm gonna escape the welfare analysis. I'm happy to talk more about it. And let me just conclude by saying that this paper emphasized the role of an independent central bank on reserve accumulation in an environment where government lacks fiscal discipline. And basically, this emphasized three key ingredients of central bank independence, which is that an independent central bank might be more prudent than the government about the use of reserves to finance a public deficit or finance public spending. Two, central bank independence allows central banks to manage reserves without interference from the government. And three, international law protects central banks' reserves in case of default. So this is why the central bank can discipline the netted position of the economy by accumulating reserves and not other assets. Basically, I show that these two ingredients rationalize 82% of the average level of international reserves observed in Mexico. And I will say that I show that by accumulating reserves, an independent central bank is able to shift resources toward the future in a way that cannot be undone by an impatient government. So this is all that I have today, and thanks a lot for your attention.